Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
It's Tuesday, April 10th, 2018. Welcome to the podcast. Hope you had a nice weekend and a good start to the week. My weekend was spent good quality time with the family. Watched the Masters golf tournament and that huge comeback by Jordan Spieth on Sunday. He fell just short, but man, what a heck of a display of just big time golf under a lot of pressure. I mean, even if you're not a fan of golf, but you're just a fan of big sports moments, it didn't get much better than that. I mean, it was really good to see, a lot of fun. I don't play a lot of golf anymore, but I do appreciate guys stepping up under pressure. So it was great. I also I'm really enjoying the torrid start to the season my New York Mets have had. They're 7-1. They just swept the Nationals in D.C. So as a Met fan, you don't get a lot of those. I mean, the last couple of years we've been okay, except the last year. But always great to see the Mets get off to a good start. But I got to tell you, it just doesn't feel like baseball season. You know, when I'm watching guys wear hoods and face masks because it's so freaking cold out there, it just doesn't feel right for this time of year. And I got to tell you, as I'm getting older, I am just getting so done with the cold. I mean, I say to my wife all the time, why do we live in New York? Remind me again. Anyway, this week I had what my wife would call a typical Mike moment. So I'm at my son's lacrosse game, and it hadn't gotten started yet, and I'm talking to a few other dads, and this guy walks up to me, and he's got a big smile, and he says, "Hey, Mike, great to see you, pal. How are you? You know, what's going on?" Look at him, and it's not coming to me. And oh my God, we drove an hour to get here, but Ben's real excited for the game. And how's Chris and the kids? What's going on? And he tells me about his family and everything. And I literally have no idea who I'm talking to. Nothing. I mean, there are times where I'll run into people in our village, and I'll run into them, and I recognize their face but not their name, and we'll have a few minutes of conversation. But this, I had nothing, but he knew everything. He knew about my kids. He knew about my wife. He was talking as though I knew his family and his wife. And I'm struggling, but worse off, I'm sitting there with a few other guys. So now you come up to that time where you've got like that awkward moment where, okay, you got to introduce him. So I didn't even know where to go with it. So what do? I said, I'll be right back. I got to run to the bathroom. So I leave those guys, them hanging. They can introduce themselves. And so, but I didn't even know where to go. I had no recall. So I run out to the parking lot. I get on my cell phone. I call my daughter. She's 14 and she knows pretty much everything about everyone. We call her Scoop. That's her nickname. So I call her up. I said, "Honey, help me out here. Do we know anyone who has a son named Ben?" She's like, "Yeah, Dad." And she goes on to tell me. Well, it turns out these folks live about an hour away. And they're friends of my sister-in-law. And I've met him a couple of times over the years at a barbecue, and I just had no recollection. But she gives me the children's names, the wife's name, what they do. So now here I am. I come back. I walk up to him. I say, "Hey, how are you, Tim? How's everything?" And we have a really nice conversation. I ask about the family, and she saved me. So, but man, I'll tell you what. That's happened a few times, and there is nothing more embarrassing. It's bad enough when you're around somebody who you kind of know and you have to introduce them, and that's that awkward moment. But when you have no recollection, I mean, that's a tough one. So anyway, that was my weekend. What else did I do? Oh, here's something. So as an investor for 20 years, I've learned a lot, right? I've done all that 20 plus years, whatever it is. Probably throughout my career, the most complicated thing I've had to get my head around is how to keep my files. It's not reading balance sheets, cash flow statements. I can do that in my sleep. It's organization. So over the years, what you do is, as an analyst and a portfolio manager, you walk around with a notebook and you take notes. A day in the life of a hedge fund, I might talk to 4 or 5 companies. If I'm in the office, an analyst or 2 comes in and tells you what they're working on. You're taking notes, right? You're taking notes and you're writing down and put it on your desk, and because you're going to reference it back sooner rather than later. And then another month goes by and you go through another notebook, and that notebook that was on your desk goes on into the corner on the back shelf, and then they start to pile up. Well, after a lot of years, you can imagine how many notebooks I have. And 3, 4, 5 months down the road, something comes up where you need to remember. You say, oh, yeah, no, I took notes on that, and I've got to go back. And so here you go, and now you're rifling through your notebooks trying to find it. Now, you would think that there's a better organizational way, right? But by the way, I'm not alone. A lot of my peers would do this. So as time went on over the years, everyone has laptops, and I tried it. I really tried. I'd be on the phone. I'd take notes. I'd type, and I'd save it. And that lasted a week. I mean, I hated typing. I just wasn't my thing. So I always gravitated back towards the notebooks. So after a while, I can't even tell you how many hundreds of notebooks I probably had. And so we built a house a few years ago, and my wife said, get those. I have an office in my basement. And she said, you know what, why don't you just put those upstairs? So I put them upstairs, and things accumulate. And so a couple of months ago, we went on an attic cleaning binge. And so one Saturday, my wife decided we were going to clean the attic out. So somewhere along the way, all those notebooks, which were in boxes, they got thrown out. So years and years and years. Now, I never referenced them. I wasn't going to go back to them. But, I kind of like knowing I had them. But they're gone. So I said, okay, I'm going to take the plunge, and I'm going to do like I see all these millennials do. You walk into a diner or Starbucks, everyone's on their laptops. I said, that's it. I'm committed. And so I went out. I bought a Microsoft Surface. I bought a laptop. And I did the note thing, and I tried, and I would read. I love to read the newspaper. I love the tactile feel. I even ditched that. I would read the Journal, the FT, you name it. I'd read everything online. And my kids said so. They said, well, Dad, look at me. It's great. I mean, everyone uses a laptop. That's, it's really good. And in my office at my house, I'd have big screens on my computer, and I'd put those to the side. So it was new age Mike. And I can't do it. I was struggling. I told myself the first month, wow, this is great. I'm so organized. I know where everything is. But in the back of my mind, I knew it just it wasn't me. And I missed my newspaper. I missed having my coffee with a newspaper and reading it. And as organized as I kind of felt, I missed the clutter on my desk. I missed rumbling around saying, where is that thing? So this weekend, I made a big decision. I decided that I'm putting my screens back on my desk. I'm putting a laptop in the corner, and my notebooks. I got all excited. I had some fresh new notebooks that I could get going, and I started a new one, and I got my papers all over the place, and I feel like I'm back. So that was my weekend. Had some sports, some watching, some interesting experience, not knowing someone, and my lack of organization is back. So here we are. So let's take a look at the markets. Last week, another crazy week. Volatile as all get out. The major indices were just all over the place. It's just a barrage of headlines. It just kept coming at you. Right? Trade wars, rising interest rates, whipsawing everything. I think at one point, the Dow swung 1,100 points from its low on Wednesday to its high on Thursday. And then on Friday, it decided to drop 767 points. Now, I record this on Monday midday, so I won't opine on it, but it looks like it's off to a decent start, up about 1% or so. But for the week, with all of that noise and whipsawing, the Dow was down about 0.7%. The Russell fell a little over 1%. The S&P was down 1.5% or so, and the NASDAQ got hammered down 2%. And it's the usual, right? Talk of trade wars. It's dominating the narrative. After Trump came out and said, we're going to put $50 billion tariff plan on Wednesday. And then he followed with an order to the U.S. Office of Trade Representative on Friday to see if he can appropriate under Section 301 to impose an additional $100 billion in tariffs on the Chinese. And then the Chinese came back and said, we're going to put $50 billion on you. And so, okay, so that started that was the week, and it was getting crazy. And then Larry Kudlow, the new economic advisor to Trump, came out and said, wait a second, calm down. Doesn't mean it's going to happen. And the market got excited again, and we saw the rally. And then Secretary Mnuchin, Steve Mnuchin, Treasury Secretary, he came out on Friday and said, you know what, there could be a potential trade war. That took the market down. So it was just absolutely crazy. And then you add a little gasoline to the fire, and you had Fed Chairman Powell towing the party line on Friday, saying that I think he spoke to the Economic Club of Chicago, that he sees more rate hikes coming and he sees inflation picking up, and the market didn't like to hear that. So just another volatile week. And, I've been sounding like a broken record, but I just keep advising, and I have for months now to take any opportunity for strength in the market to lighten up your equity positions. And I won't go on and on as to why. You've heard me talk a lot about it before. But for the week, I mean, the tech sector got hammered down 2.3%. We saw, Facebook, they're facing a lot of issues with their the use of their data. You've got Zuckerberg testifying coming up this week, I think, to Congress. NVIDIA, which has been a darling due to the crypto cards that they make, that's been under pressure. Just tough in tech land. So, just keep being cautious. But one of the things that has struck me is, the bulls have pointed that global growth is finally heating up after years of a malaise, and they pointed to output growth globally of about 3.5% in 2017, and that's going to continue. But we're starting to see something that might indicate a little bit differently. The data is starting to suggest that 2017 could have been a blip. If I look in the U.S., I see retail, they've been down for a few months. Construction spending is starting to slow. The latest jobs report, big slowdown. I mean, it had been on a big run, but we saw a big slowdown. You add to the mix the trade war rhetoric between China and the U.S., and all of a sudden, the rosy growth outlook can definitely be called into question. If you look at copper, which goes into so many things and is kind of like a canary in the coal mine for growth, it's off about 7% for the year. Over in Germany, industrial output in February surprised people. It fell about 1.5% of their latest data release, not a ringing endorsement for global growth. And like I said, you've heard me go on, and I'm bearish, but I think it's something that we really need to keep an eye on, and something you need to think about in terms of, because that's what's going to take stocks higher if they go higher is this global growth. So I want to talk about the trade wars, and there's so much that's said, who wins, who loses, and let's break it down for you. So but more importantly, not who wins or who loses, but I want to put it in context of the market. So who wins economically? Well, the U.S. China has more to lose economically if you had an all-out trade war, right? The Chinese economy is dependent on exports. I think 20% of their exports go to the U.S. It sold $560 billion in stuff to the U.S. last year. Flip that, the U.S. sold $130 billion to the Chinese. So in a real economic battle, the U.S. wins, no question. But we have to think beyond an economic battle, right? Because there's also a political battle underfoot here. And there's a very strong case that you can make, I think, that Trump would be less able to sustain a protracted conflict than the Chinese can. And you also have to take into account the 2018 midterm elections, which are right around the corner. Let's think about China for a minute. President Xi Jinping runs a communist country that has just granted him the ability to rule for life. Think about that. Right? He's there as long as he wants to be. He controls the media, and he's sitting on top of about $3 trillion in surplus cash. This means that he can move very fast to what to whatever Trump does. Chinese companies get hurt by the tariffs. He's got the cash to help them. Soybean prices go through the roof because of the tariffs. It's okay. He could subsidize the consumer so they don't get hammered at the grocery store. And it wouldn't be unprecedented, by the way. China did this in the global financial crisis in 08 and 09. They plowed money from their surpluses into the economy and they stimulated growth. And they want to kind of wall off their people from feeling the pain. And if you think about what's going on with the rhetoric coming out of Trump, he's pissing off his own party. I mean, they're angry at what he's doing with the tariffs. And if you think about law, if you're a lawmaker in the Farm Belt, right, the American farmer can really get hurt by this. If you're the CEO of a large company that supported him, Wall Street, you're pissed off. And think about who the opponent is. China, CEO, president for life, right? They play a very long game. They have cash and they can wait. It's a big difference when you're dealing with somebody, with China. The U.S. Trump doesn't have that luxury. They can withstand a lot more over the next year, 2 years, than the U.S. can. If you think about the levers that China has, what can they do? Well, they can stop cooperating on North Korea. If they really wanted to, being the largest debt holder, they could sell U.S. debt and that would rattle the markets. They can make it difficult for companies operating in China. Think Apple, think Nike, think Disney, right? They could put the screws to them, right? Now, are they going to sell debt? Maybe not, but they have the opportunity to do that, and they buy our debt too, right? That when Treasury needs to issue bonds, they're there, but they can hold it as a bargaining chip. If you think about what Trump has, except a lot of bluster, he doesn't have those cards, right? The U.S. government doesn't have direct control over companies operating here, right? And you hear him say, well, we're already in a trade war and we've been getting attacked for years. Okay. If you think about and focus on what's going on in China, the politicians face enormous pressure, even though you have president for life, but they have to protect and project their country as a world power. And if they are viewed by the populace as rolling over to a bullying Trump, that's a very unpopular thing to do for them. So, if we think about from a political standpoint, right? So Trump has threatened $150 billion in tariffs. So essentially, he's threatened taxes on about 30% of the goods that the Chinese sell into the U.S. Now, it's unlikely to damage the overall economy significantly, but it's getting to the point where American consumers are likely to face higher prices on TVs, on clothes, maybe iPhones, right? And if you think about who gets hurt by this the most, it's hard for a farmer to understand why they're the victims in a fight against China, right? If you look at, I think the Brookings Institute put something out recently and said that if the tariffs went into effect, it would affect 2.1 million jobs in 2,700 counties across the U.S. 82% of those counties voted for Trump in the last election. So what does winning look like, right? So Trump has three key issues with China. One is the trade deficit. Two is the Chinese intellectual property theft. And three is China's industrial policy. Okay. But the problem is he has no plan. He's just saying, I want change. Well, what does change mean? Give us something to work with, right? And he's been out saying a trade war is going to be easy to win, right? Sure, we can win. I mean, Xi has made it clear he doesn't want a trade war, but he can respond. And he's setting himself up really for a political win if anything goes south on the economic front. Right? So it's Trump is a bully, and we're standing up for what's right for us. And don't worry, Mr. Consumer, we're going to subsidize you a little bit, and we're going to make it tough on the American companies doing business here. So what likely happens? Yeah, I mean, my guess, best guess, you'll see a few concessions made by the Chinese. Not many, some. Trump will hold a press conference, and declare victory, and say, look what I did. Not much will change. But so what does that mean? Stocks have been under pressure, right? In part because of the trade war fear. So does that mean we see, everyone, it's good times here again? This is where I think it's very important to put the trade wars in context, to put who the opponent is. If you're an American, who are you thinking about? It's the Chinese. But now here's where it's important about what to do. So we know the market doesn't like uncertainty. Let's think ahead. Trade wars get cleared up. Great. And we see a snapback rally in the market. Now, we know it doesn't like uncertainty, so that puts uncertainty, takes some of it out of the game, and that's good. And we've also heard the saying that bull markets climb a wall of worry. So there's always something to worry about, but look what happens. Stocks keep going up, and they climb that wall of worry. But let's step back for a minute. Let's think sober, and let's think about where we are in the cycle. We've had a 9-year-long bull market in stocks. With the exception of the internet bubble in 2000, valuations are as high as they've ever been. Now let's think about what enabled stocks to climb that wall of worry. We've had a global central bank experiment. We've had of quantitative easing, easy money flow the world has never seen before, 5,000-year low interest rates. Despite that, companies have been stuck in this low growth environment for years, struggling to get top line growth. I mentioned earlier 2017, 3.5% growth, nothing to write home about. So to get the earnings that they needed, they cut massive costs out of the business, which more than offset the lack of sales growth. So they cut costs, cut SG&A, cut R&D spending, cut CapEx, cut employees. And then when the top line growth still didn't come, what did they do? They used their balance sheets. And they took advantage of these low interest rates to go borrow money at absurdly low interest rates, next to nothing. So what does that do? They borrow money, they issue debt, they take in cash, and they buy back stock. What does that do? That lowers the shares outstanding, and in the formula for earnings per share, it increases earnings. Now, a lot of that debt, though, I think it's something like 40% of the Russell 3000 companies is tied to floating LIBOR interest rates. And LIBOR has doubled in the last year. So when that debt matures, the companies could be facing much higher interest expense on new borrowings, which ultimately could hurt earnings. So what bails companies out? The global economy that everyone's waiting on, right? Growth. But as I mentioned at the top, it's not a given. So what I do is I step back, I look at the risk reward. Now, when stocks were at record low valuations in 2009, not a lot needed to go right to see a move up. There was maximum pessimism, even with QE starting to come, quantitative easing, and an accommodative policy. Still, they were trading, I forget where they got 9-10 times earnings forward on the S&P. So any bit of good news was going to take stocks higher, and then it just kept going for all the reasons I just mentioned. Let's flip it, though. Today, we're at record high valuations, or near record high valuations. A lot has to go right for stocks to move much higher. Now, if you've been fortunate enough to be along for this ride in the market for the last decade, that's fantastic. But remember that bulls and bears make money, and pigs get slaughtered. So you need to start thinking about how to cautiously position yourself. It's not enough to say, okay, the trade wars are going away. That's consuming CNBC and the Wall Street Journal, all the headlines. That's the mainstream financial press. You need to step back and think about the risk reward of where the market is and what you own. I can't repeat that strongly enough. Right? It's about risk reward. How much upside do I stand to gain versus the downside potential if things don't go as expected? And are things at these valuations expected to go well? Yeah, They are. Forget the noise of the last couple of months, the market going down. They're still expensive, and they're a catalyst that could take them down. Then ask yourself, okay, what's going to surprise the market to take things much higher? What's that surprise nobody's thinking about? I'm having a hard time finding it. So I'm going to bring in a guest today where we're going to talk about a lot of the stuff that I just mentioned. We're going to talk about China, the geopolitical risks faced there. We're also going to talk about how to think about the investment world from a real top-down macro viewpoint. And my guest manages to kind of lift himself from the fray and not pay attention to the noise. And he's always trying to look a couple of steps ahead from where the market is right now, which is a very good exercise to always be doing. And he's going to talk about some ideas that he think are ideas that are off people's radar screen. We're going to touch on some commodities and where he thinks that's going. Let me bring in my guest, who is a New Zealand-based fund manager. He also writes a newsletter, which I read and I think is very, very good. He has a contrarian bent to it, which I am. And I'd like to bring him in now to talk about his view of the world. Chris MacIntosh of Capital Exploits. Welcome to the podcast.
You're welcome, Mike. It's good to chat again.
Thanks for coming on. I've been a big fan of yours for a while. I read your stuff and I think you just do really great research, and your investment ideas they seem to click with me. And, you and I have something in common that we're both contrarian investors, and we look at the world maybe a little bit upside down, some might say. But why don't you talk a little bit about your background, what got you to where you are now, and maybe a little bit about your investment philosophy.
Okay, I'll try and keep it short because I think it's good if we can kind of dig into where we're at today. But
yeah.
The short answer is I spent some time working as an investment banker. Originally studied law, which I never used at all, and that was a complete waste of my time. But I guess it gave me an inkling into looking at finer details and things of that nature, which as a lawyer you need to do. I was pretty lucky at a very, very young age to make very good money trading. I was trading oil contracts back in the 90s, and I made really good money. It was what was really good money for me at the time. And I'm really glad that happened to me at a very young age. I think I was 23. And the reason that I say that is because I made all this money. I turned around, I realized clearly that I was a genius. And then I went and I obliterated the entire lot on a number of subsequent investments, quote unquote. And I did some really, really stupid things. And so that was like you can get educated in university and all that sort of stuff, but you kind of have it real time where you make good money and then you make horrendous losses, and you're going through all of the psychology in your own head behind that, and sort of marrying that with analysis or indeed lack of analysis. Is probably a more apt description. That was very, very valuable. So that was kind of a bit of a education by fire that I had earlier on in my career. And then I've always been a bit of an entrepreneur, so I started investing in at the same time that I was obliterating all of my wealth. And as this is while I was working full time. I think I was at JPM at the time. I started investing in residential real estate. This was over in the UK, and just I guess being much more entrepreneurial. I mean, what I was there was, quite frankly, Mike, as a slumlord, I would go and I'd lease large old Edwardian places in London on a long-term lease, and then I'd sublease them out on a short-term basis. to Antipodeans, and I'd stack as many of the buggers in as I could. And I'd capture the margins, and the margins were pretty good. I was running between 30 and 50% margins.
Wow.
And so I kind of got to the situation where I was working, it was 70, 80-hour work weeks, and then running over 30 properties across London, and became a bit of a mess. But I learned a lot, and I also learned that I could earn passive income, which then exceeded what was a pretty good stipend from my employer. And so that then, naturally made me question how you go about spending your life, quite frankly. So that was where I realized that working for somebody else was not going to work for me. And then I went and left the UK and traveled quite a lot. Landed up building a real estate investment and trading company. Selling all of that down, and then trading commodities and FX markets and you name it. I kind of jumped around a little bit. Most of that was based on a kind of global macro view. I've always been afflicted with this problem of being interested in everything and wanting to know how it works. And then I sort of look at sectors and say, well, what's the most probabilistic, and where can I get the most bang for my buck, given my view of the world? And then that's typically honed me into particular areas. And so it happened to be real estate in the sort of 2000s up to 2006 when I liquidated everything. And then from that point on, it happened to be more in the venture capital space. So it's kind of always looking at this kind of global view and then saying, okay, well, what's happening? Where do I think that the most asymmetry lies, and how do I go about tackling that? Because I'm not necessarily a professional in any one area. And so that's kind of how I've gone about doing things over the last, 2-3 years. I set up a fund with a buddy where we trade equities, bonds, you name it, across the globe. Again, looking for that asymmetry. And that's been really successful. And then launched the research service, which augments that. And it's, I kind of sat there and I was like, well, I'm doing all this work and on how to allocate my own capital. And quite frankly, it makes a lot of sense to have that augmented with revenues that can help pay for analytical staff and all of the kind of carry-ons that go with a fund. And then it can be something that people who don't necessarily want to invest in the fund, well, the fund's closed at the moment anyway, but who could take advantage of some of those ideas. And so that's kind of what I've been doing for the last couple of years. And here we are.
So let's talk about that, Chris. So you mentioned asymmetry. So our listeners are from individual investors to professional investors. So let's break down asymmetry a little bit more and contrarian. So you say, you have a big picture view of the world. There's a lot of ways you can express that or think about it. You could think about looking at things that are working in real time, that are moving quickly, that are facing big trends, or you can go to the other end of the spectrum and look at things that are out of favor. And as a contrarian, you're tending to look at things that are out of favor. So talk about what it means to be a contrarian, and if you can, what you mean by asymmetry and what you're looking for from an investment standpoint.
So I think the first thing to actually think about with that particular question is what everybody misses in this. You think about asymmetry, everybody thinks about how you're going to make a lot of money, right? You're going to turn, 10 cents into $1 or something of that nature.
Yep.
And that's what you hope for. But hope's a terrible strategy. The most important thing, bar none, and this doesn't matter whether you're a trader, which I've been in the past, or an investor, long-term investor. The most important thing, and Buffett has pointed this out many, many times before, is to not lose money. And that means that the risk to any investment needs to be quantified, and that risk needs to be relative to the upside. very, very low. And so what we tend to do at Insider and with the Asymmetric Opportunities Fund that we run is we start out looking where the lowest risk happens to be in any sector. Now, I've always kind of looking at multiple different pieces of that particular puzzle. And this can be geopolitics, it can be debt deflation, it can be, the rise of China as a global power. There's a lot of different factors, and you can look at how they impact all of that. But if you're just starting with one point, it's saying, okay, how do you find a sector where the risk to that sector going substantially down is relatively low? And then the next question is, okay, how's it priced? And if you find that it's priced, such that everybody thinks it's already fundamentally very valuable and it's not going to go down significantly, well, then that's not that interesting. But that's very rarely the case. And you'd know that from looking at the uranium sector, a sector where we've got about 80% of the companies that were in URA, which is the ETF, don't exist anymore back from the peak. Those companies have gone away. And then not only have they gone away, the companies that are left sitting in that ETF, their valuations are a fraction of what they used to be. And then you say, okay, well, that's interesting, but something just because it's gone down doesn't mean it can't go down anymore. So you say, well, what causes something to go down? Well, debt's typically, a killer in any market where you can't get financing and so on and so forth. So you look through the capital structure of many of these companies, and you find that they've been restructured, or they've been acquired, and they've been acquired through a restructuring. And so, if you think about, it's almost like Pareto's law in reverse, Mike. Mm-hmm. So Pareto's law, the good old 80-20 principle, where 20% of everything, or 20% of the value in any one sector typically produces 80% of the results, and so on and so forth. So if you've got 80% of the companies that have gone away, the 20% that are left, by and large, and we're just making generic statements, they've picked up the 80% of those assets, because all of that, the infrastructure and the assets and everything else that existed with those 80% of the companies, they still exist. They didn't just wash away. They just changed hands. So now you've got the 20% that owns effectively now 100% of everything. And so in that situation, you say, okay, well, debt's been restructured. And then you just look at your income statements. You say, okay, well, are these guys making any money? Well, relative to where they've been. And so you kind of run through this situation, and you see that, the uranium space, many of them are still losing money. So you say, okay, well, they could continue to lose money. And then you look at the factors behind the supply and demand of the uranium, because at the end of the day, you look at it and you say, well, we could have a Kodak moment, right? And maybe this, I'm just picking on uranium. Yep. Maybe this thing's gone away and we're never going to see uranium again. That's possible. Okay. What are we paying for that probability? And so you kind of run through all those things, and you find these sectors and these setups where the risk is very, very low. And then you start looking at what all those drivers behind it are. And that's really, that's as simple as it is. Yep. It's one of those things, I don't know who said it, but it's like, it's simple, but it's not easy. Something along those lines.
I think about it, Chris, like simply, heads I win, tails I lose a little when I'm thinking about asymmetry.
Exactly.
Right? Exactly.
Yeah.
And that's kind of what you're looking for. That's what I look for when I'm looking at these ideas, both on the long side and short side. Yeah. Let's shift gears a little bit. I know, you spend a lot of time thinking about the broader picture, and it's not always easy. When you're thinking about, if you're paying attention to the financial press, you're seeing, the headlines right now with the Russians and the election meddling, and the Americans are imposing sanctions on Russia, and you've got the U.S. blacklisting oligarchs. You've got this talk of the trade wars with the U.S. imposing $100 billion in tariffs on Chinese goods, or wanting to, and the Chinese responding in kind, and that moves the markets day to day. But that's all for like the here and now. As I know you do, and I do as well, is I like to think a little bit broader outside of that. And when I think about China and Russia, yeah, they're in the headlines and we're focusing on those that I just mentioned. But as I look at the world right now, what I'm seeing, aside from that, is this ever-strengthening bond between Russia and China. And I try and think about the implications from that bond. And I think about what's driving it. And I look at a relationship that was from the 1950s till the end of the Cold War in the early 90s was broken. It was damaged. The Russians and Chinese didn't really, at the government level, didn't like each other, right? But now you're seeing this closer cooperation, which is really driven by nothing more than mutual interests and common threats, being the United States. And so there was this interesting time when you go back to the early 70s, I think it was 72, where you had Nixon and Chairman Mao get together, and it really created this historic meeting where there was this détente between the U.S. and the Chinese and on one side, and you had this whole Soviet containment in the Asia-Pacific region on the other. And that's all gone now. I mean, after the Cold War ended, you saw Yeltsin go and visit China, and in the early 90s, I think it was 93, and then that morphed into a series of strategic cooperation agreements that they signed in 96, and a whole host of agreements since then around energy and military and selling arms back and forth. And so as I think about now, and I think about China's role in the world, and I think about Russia's role in the world, and what I see is I look at Putin's pet project, which we don't hear in the West, we don't talk a lot about, which is the Eurasian Economic Union, which is called the EEU. And then I look at the China-led Belt and Road Initiative, which really was called One Belt, One Road, to revitalize the old Silk Road back in 2013. And that was really the onset of China's really ambitious foreign policy, where they're spending $150 billion a year across 68 countries to really break with the old Chinese dictum of hide our capabilities, bide our time, but don't let anyone see us trying to take the lead. That's out the window now. They really are focused on global open trade projects. As you think about the world as it is now, and you think about investing, what role, let's start with China. What role does China play from a global power standpoint? Let's look at it different ways. Let's think about it economically, politically, and militarily. How are you thinking about that?
Well, I don't think that you can separate any of those three elements out, because there's a feedback loop between all of them. What is fairly evident to me, firstly, is that China have got a very, very long horizon in the terms of the way that they view themselves, which is very different to how the West views themselves. And we can see that in the political system. So in the West, you've got pretty much 4 years to do something. Yeah. Because, at the end of the 4-year period, you're up for re-election. And so there's this very short window, which is not a window sufficient to actually get much done. Right. Certainly with the construction of Congress and things of that nature. And this is not just the US. This is most of the Western, we'll call it Western world in general. Their political infrastructure, if you will, is such that it pushes leaders towards short-term outcomes because that's what's required to keep them in power.
Yep.
China, on the other hand, doesn't have that. In fact, China now have got, Xi Jinping.
They have a lifetime president.
Exactly. And Russia's the same. And so there's a very different, the way that they can go about enacting policies and determining their final outcome is very, very different. And so that then impacts foreign policy, it impacts investment, it impacts military. So from the Chinese perspective, what we have seen, and this is consistent with their history for thousands and thousands of years, is the mercantilist, right? So the traders. And they've been expanding in that realm for the last 30 years, and that's now been really on steroids for the last 10 years. Obol is just the icing on the cake, I guess, if you will, for that very same plan, which is to extend economic interests throughout the world. And it makes a lot of sense if you're becoming, as they are, a global power. At the early stages of gaining that economic power, you can't waste resources. And so you're very much, it's almost like a startup. Like a startup doesn't have or shouldn't have large office space and fancy office space, down in the middle of Manhattan. No, they're going to be sitting out in the Bronx, or they're going to be in Brooklyn, or they're going to be like, you know what I mean? Yep. So they're gritty, and they're just focused on building, and they're not going to get chauffeured around in limousines, and they're not going to have private jets and all that kind of stuff. So I think it's quite a good analogy with a startup as opposed to a big behemoth.
Yep.
That then starts spending a lot of money to sustain, and often that behemoth then isn't so focused on growth, but it's much more focused on keeping the status quo, and keeping the power that you have. And we've seen this through, when the Brits ruled the world, and prior to that, the Spanish, and prior to that, the Portuguese, and everything else. So if you look at China, they've been building their economic power while being very, very careful not to get engaged in military endeavors.
Yep.
And I think that's going to continue for as long as it's going to continue. But what is plainly evident from history, and is now increasingly at risk, is that at some point those economic initiatives that they've spent time and money building come under threat as a consequence of political pressures. And there is the need, or the decision, I guess, to be made to protect those economic interests. So if we just took, for example, Greece. Okay, so Greece has been at the forefront of China's policy for the Obol project in terms of getting access to Europe. So they've bought the ports, they've bought the airport, they own a lot of the infrastructure, and this is now across the world, but we'll pick on Greece because it's a good example. Let's just say, for argument's sake, that the US and Russia now have a bit of a bust up, and the US decides that they need to go and put some submarines and battleships in strategic locations. And Greece has always been an ally of theirs. So now they go to the Greek government and go, we're going to put a battleship in Athens port, and we're going to put a couple of submarines in there. And the Greek government says, well, I guess that might be fine, but kind of at the end of the day, we don't really own the ports anymore.
Yep.
So we need to be careful about how this goes about. And then the Chinese sit there and they go, well, do we really want to have US submarines in a port that we own that are threatening Russia? And if you look at what's been happening, and you correctly identified this, Russia is not just a friendly party to China. Russia's more like an alliance at the moment.
Absolutely.
And there's very good reasons why that's
Yep.
One of those main reasons is that they've got energy that the Chinese desperately need. And they have a common foe, if you will.
You're going right where I'm thinking, Chris. Yep.
So you then get these potential situations which could end very, very badly. Now, that's sort of, we're just watching all of these pieces moving on the puzzle, right? And that's just one example. There's many across the world. But what we do know is that China has been making these economic investments throughout Africa. I mean, if you just look at oil,
yep,
like energy. So Saudi Arabia, which has been, the kingpin in energy, and it's been a very, very strong ally of the US and so on and so forth, which, from the Chinese perspective, they decided literally not to go there. And they went and they negotiated oil contracts with the Russians and Angola. And so I think it was 2016, don't quote me on this, it was 2016, 2017. In terms of trade partners, Saudi Arabia dropped to number 3 in terms of energy with China, and China's like literally the world's largest trading partner for everybody. It's the US's largest trading partner, the Australia's largest trading partner, it's Europe's largest trading partner. It is the behemoth out there. I mean, at the moment, it's about 15% of global GDP. So, anyways, that's that was significant, and they built up those contracts. And again, and there's another factor here, is they started trading those oil contracts in renminbi, which also gives them a lot of flexibility in managing their currency exposure. Mm-hmm. Because, as you'd know, if you get the currencies moving against you, you can get wiped out pretty quickly, and we've seen that before, like in the Asian crisis, right? Yep. So they're smart. They realize that these are significant issues that they've got to try and de-risk. So they've built all of these sort of, as much as they can, these economic moats and relationships around the world. But again, at some point, there is a risk that alliances need to be made on a political level and not just an economic level in order to protect those economic interests. The two are intertwined, and you can't get away from that. That's just the reality. So at the moment, they have very strong economic alliances throughout the world, especially in Africa, because they've been looking for resources, but all over the place. And so if push comes to shove, and increasingly we're seeing that literally daily, there is the risk that this gets a little bit more out of hand. I mean, I had traders over in Aussie, and I was just over there a couple of weeks ago, and I'm looking at Australia, and I'm looking at the numbers there, and philosophically, I guess, the Australia has always aligned with the US. But if we just look at the trade numbers, they're aligned with China. So tell me, Mike, what happens if the US turns around and says, well, we're putting all these sanctions on China and we want our allies to follow. So they turn around to the Australian government. They go, well, we don't want you guys to be selling goods to the Chinese, or we want you to join us in punishing them with tariffs or whatever, some sort of policy initiatives. What do you do if you're the Chinese, if you were the Australian Prime Minister? That's a tough one, because
it's a tough call, because your economy depends on them.
Your economy depends on them. To a large extent, your defense has been depending on the US. So you've got this situation where it's like the largest military power is still the US, but the largest economic power is China. And here's the thing, many people don't realize this. I mean, I was having just a bit of a joke the other day, sitting in a business lounge at the airport, and I was chatting to there was a couple of businessmen there, Americans, and I wanted to just test this because I haven't got any empirical evidence about it, but I suspect it's consistent. And I said to them, they were doing these were guys that were doing business in China, and I said to them, what's the biggest economy in the world? And they're like, well, it's still the US. And I was like, okay. I said, well, what are you seeing in China? No, well, it's growing, it's really, it's going ahead, and all very positive. And I said, well, how do you see things moving forward? Oh, well, they're going to become, the ruling power for sure, and economically. And I said, what's your time frame? Maybe 20 years. And I because I've been looking at the numbers. Yep. So 2015, China became the world's largest economy, measured by purchasing power parity, which, by the way, is what has always been the relied upon metric.
Not the absolute.
I don't know if you remember, but at the time when that came out, there was all sorts of hoo-ha, and there was a lot of economists at Harvard and stuff going, oh, no, we shouldn't measure it by purchasing power parity anymore because it's not fair. They got like 1.4 billion people, and so we should measure it by something else. And it's like, at the end of the day, it doesn't matter. That's what they always bloody measured it by.
Right.
You change your measurement statistics, but it's not going to change the fact that this is where things are headed. So I kind of found that interesting because there was 4 of these guys. They were all businessmen doing business in China. So these were guys who ostensibly should know a lot more than your average Joe who's not even been to China. And they still believed that America was the largest economy. And furthermore, they believed that China was going to only become the largest economy in like 20 years' time.
Yeah.
And so there's a big divergence between what is already here and what is the common held view. And I think that's quite dangerous. If we get into more conflict, and that can be conflict on an economic front, and which again almost always translates into some sort of political conflict too. And I say it's dangerous just because it's very easy to make miscalculations when you don't understand what is actually the reality on the ground.
Well, when you think about the creation of a Chinese-Russian entente, if you will, in Central Asia, I mean, it eventually places a huge swath of Eurasian landmass under the influence of these two countries, right? You're never going to have Russia being the flag carrier for Beijing, right? Russia's too proud for that.
Yeah, but they don't need to be.
But they don't need to, right? With this Belt Road Initiative, where China can really exert its influence in Central Asia, and Russia plays the role of protection in that part of the world for them. And it just expands China's global goal, and it consolidates Russian power in that region, very stabilizing for the region. And, that has farther ramifications when you think about it. I mean, when you have a system that's designed to control a large resource-rich swath of land where two leading superpowers can enforce their model. I mean, that has far-reaching implications, not just in that region, but around the rest of the world. And that's kind of some of the things I'm trying to think through, versus the day-to-day movements of the market because of a headline about the British boarding a plane of a Russian plane when it lands at Heathrow or something else. But it extends farther beyond that. So when you think about that, how do you express that view when you're thinking about it from an investment standpoint?
Okay, it's a very good question. Firstly, we've got a country which is hungry for resources. Even when it's growing modestly, it's growing at sort of twice the pace of any of its Western contemporaries.
Yep.
And you could look at that, this little island that I'm sitting on now where there's literally no people. We could grow it like 30% a year and we wouldn't have any impact because we're empty. There's no one here,
Tell people where you are.
New Zealand.
Yeah.
So which is why I like being here. But, but when you've got a country with 1.4 billion people, even 1% of that is significant just by its sheer force. It's like a massive asteroid as opposed to a pebble. And so that's, on aggregate, it has a very, very powerful move. And so I'm very wary of that with respect to what they need and what they can achieve. So there's a couple of elements. If I'm going to let's dig into, where would you allocate capital? So one of the things that we've been looking at a lot at is renewable energy, for example. And so in the renewable energy space, China spends more money than any other country on the planet in that space. It's the largest generator of solar power, bar none. In fact, I think it doubled its output in 2016. It's got like the world's largest floating solar farm. The fact is that they have a terrible pollution problem.
Yep.
And they realize that that's also can potentially be a civil issue for civil strife and things of that nature. And so they're very cognizant that they can't have that. And they don't want another Tiananmen Square. I mean, they want to have a happy populace.
That's why you see renewables and nuclear power in China growing.
Exactly. So those are kind of obvious sectors to look at, and forget about like the noise that you get out of, the West with, I laugh at companies like Tesla, which is just, I mean, it's completely inconsequential when you look at what they're doing compared to what China's doing, and no one's really paying attention to it. Anyways, so that's really significant. And then coming back to what we discussed at the start, which is low risk, let's just pick on solar, which is alt energy. I mean, one of the things that I managed to look at, and this is a consequence of running a venture capital firm for a number of years, is I look at capital flows in different stages of an economic cycle. And so what you often find, Mike, is that capital will go into a sector early in like venture capital space, and then you'll have a boom, and then you'll get like your IPOs, and then you'll get your listing of ETFs and index funds and all that kind of fun stuff, and that's the end, because that's basically your investment bankers just selling the last remaining dregs to retail in a nicely packaged format, and there's no more capital, and that's the end, and the valuations are silly, and everything crashes. And that's what we saw with uranium, and it's what we saw with alt energy. So 2005-06 was massive amounts of capital going into the VC space in alt energy. 2007, I don't know if you remember, we had carbon trading credits and all that. And I think it actually was the same time that Al Gore came out of this nonsense movie. Or was it The Inconvenient Truth? Anyway, so you had all of this.
That was after he invented the internet, or?
Oh yeah, of course.
Yeah. Okay. Yeah.
You can't do it all at once. So, and then 2007 was the listing of TAN, the solar ETF, and that, Mike, was the end.
Yeah.
Right.
Yeah.
And then, so you run a graph on TAN from 2007 through 2000 now today. And it's this wonderful ski slope. I mean, you need to put your helmet on, but that thing would have been a very, very fast downhill run.
Yep.
So, and that was where we lost about 80-90% of the value of that thing. Anyways, so that's kind of your cycle that you go through. But with the really super cool thing, and we alluded to this before, that happens in any of these booms, is that all of that infrastructure which gets built, it often gets built where it doesn't make any bloody economic sense. Like the stuff that was getting built in solar and wind and all this kind of nonsense in the boom made no economic sense.
Yep.
And it doesn't matter, because all of that infrastructure then gets utilized as your base coming out. And that's where we're at today. We have all of that infrastructure which is built, but guess what? The capex doesn't matter, because it all got wiped out and all of the poor monkeys who bought the stuff at the highs. And so now you've got this baseline, which is perfect for margin expansion. And you've got like an initiative, not just in China, but across the world with respect to renewable energy and everything else. And it's actually economic. Anyway, so that's kind of, but China's very, very heavily influencing that space aside. And that's also as a consequence of the fact that if you go to Beijing today, you've got to chew the air before you can swallow it, and that sucks. So they're addressing all of those issues. In a roundabout way, I want to ask you a question. So, because this is something I've been debating a lot, and it's as a consequence of trade wars and things like this coming up, which I've sort of been saying since 2016 we were likely to get. And I'm still of the belief that it was July 2016 when we had a top in the bond market, which was when we had about 13 trillion trading negative.
Yep. And
everything since then has been moving the other direction. And part of that is also as a consequence of these political changes, because you're not going to get the coordination at central bank level that we saw in the GFC. Like, seriously, do you think that Trump and his administration today would help bail out Chinese, Russian, European economies if they need it. It's just not, that dog won't hunt, and vice versa. And that means that you're going to get this lack of coordination at central bank level, and that creates volatility. And volatility is also in the bond market. There's a feedback loop between volatility and risk, and often people say, well, volatility is a consequence of risk, and it kind of is, but there's a feedback loop between the two of them. The point is that the narrative is changing and has changed, and there's a bit of catch up there. Now, if we couple on top of that the fact that we've got these trade wars going on, and then if we think about resources, because we've talked about resources now, in an environment where you've got trade wars, that's fairly ostensibly it's fairly bearish for global growth. Mm-hmm. Okay, so then you could say, well, commodities shouldn't perform particularly well in an environment where global growth is at risk, because you've got less trade going on, you've got, even potential wars breaking out. Like that's, it's hard to make a judgment call that global growth is going to accelerate under those sorts of conditions. And so I've heard a couple of very, very smart commentators mentioning that we're going to see deflation, because debt deflation is always debt reduction is almost always deflationary. And if we look at it from a corporate level, that's true. So like if you've got a big, again, I'll take the uranium sector, big debt build up, pay down the debt, it's deflationary. I mean, it's so that's certainly the case. And there's a case to be made for that. But when we're looking at the situation today, we're talking about sovereigns. And sovereigns, I think this is where they're getting it very wrong, because sovereigns are not going to pay off that debt. If we look at history, if they're pushed to it, and if it's certainly with the levels of debt that exist today, they're far in excess of anything that we've seen. I think to the idea that needs to be paid down, especially when in the West and even in China, we have a demographic situation which is such that that is in itself deflationary, because we've got the baby boomers retiring and so on and so forth. And so they're repatriating capital, and they're not spending, they're not investing. All of those things are deflationary by their nature. But if they go back to the governments themselves, certainly they don't have the ability to pay that down. And if we look at history, they're going to inflate it away. And that's very inflationary. It's not deflationary at all. So that's one element that I've been struggling with. I'm not struggling with, but it's kind of one of the pieces of the puzzle, I guess, on my board here. And then I say, okay, given the situation, let's rewind the clock again to 2008. Post 2008, we had the central bank coordination, whereby everybody did the same thing. Mm-hmm. Expanded balance sheets, quantitative easing, they opened up swap lines, they literally did everything that they could to re-liquefy the system. Now, in that situation, I look at it and it's like everybody did it. Japan was already on that path. They were already doing that.
Yep.
Okay. So then you just had the Bank of England, the ECB, and the Fed all doing the same thing. So now you had this coordination across the main players in global capital markets, and they were all doing the same thing. Now, when everybody's doing the same thing, there is no exit valve. Like when you had the Mexican peso crisis, the exit valve was the US dollar. It's easy. Okay. The peso goes to hell in a handbasket. The dollar, soaks it up, and there's an exit valve for people, and everything gets readjusted. And that's how Europe used to work prior to the euro. Like you would have Greece and Italy and these countries who would, periodically run up debts, and then they'd devalue the lira or the peso or whatever it was, and you'd restructure. Mm-hmm. And that's how you kind of had this flexibility in the system. And we've not had that flexibility since 2008 in major markets, because you can't move capital. Like if you're a big money manager moving just cash allocations or bond allocations, you don't have the option to move it into Norwegian krona or into, like you can't, the market's too small. You're literally stuck with euro, yen, dollar.
Yep.
And so when you're looking at euro, yen, dollar, they're all in this sort of this bad situation. So you just take home, the least ugly shirt at the end of the night, and that's just the way it is.
Yeah.
Now, I'm suggesting that that's all changing very, very quickly because those exit valves are now opening up. The Fed's raising rates. They're going to continue, even if they just hold steady. There's already a gap between European policy and or ECB policy and Fed policy. And that creates volatility and it creates an exit valve. So I'm actually quite bullish on US bond assets. I'm not buying them, not by any stretch of the imagination, but just kind of looking at the ramifications of how it flows through. So because there's a yield differential, and increasingly as we get more and more trade wars and things of that nature, those divergences are going to be exacerbated. And those the guys at the policy level are not going to accommodate, and that's really significant.
And it sounds really like it's coming down on in the inflation camp.
I am, and the reason that I am, Mike, is because there's if you go and you think about how any country in history in the past has paid off debts or got themselves, shall we say, out of an indebted situation, they've been forced into it where there's been an exit valve. Mm-hmm. So like a really prime example is Zimbabwe back when they blew the place up.
Yep. And
there people, look, the exit valve was a South African rand and the US dollar for the most part. And that's cool. But then they also had capital control. So you couldn't actually take capital out of the country. People were smuggling it out and all that stuff. But by and large, you had a lot of capital was trapped. And that trapped capital went into anything that literally held value. So as a consequence, the Zimbabwean stock exchange, stock market, should I say, went through the roof on a Zimbabwean dollar basis, okay? Because you would rather own a company that you knew had assets and vehicles and stuff than you would the Zimbabwean dollar. I mean, I met people who were buying, there's one guy who was buying fridges because he was an electrician. He understood fridges. And he's like, look, I know they're going to hold value better. So he had the whole warehouse full of fridges. It was nuts, but like, anyway. So the point is that you have a move to tangible assets. Now, the question that troubles me is, what do those tangible assets look like in a world where dollar, euro, yen are all shit, and we know it now? And you realize that they can't all move. Like if you're moving billions of dollars, as some big fund managers are, you can't go and buy fridges, and you can't buy Norwegian krona, and you can't even buy resources. You can buy resources, but you got to diversify across because like the gold market's tiny, and many of these markets are very small markets. So, but what I think is that deflation argument is wrong because the governments are going to inflate. They're not going to pay back the debt. So that's quite significant.
So how does that? So as a contrarian looking for asymmetry, where does the commodity complex come into your thinking here with the view that you hold?
Well, again, it comes back to what we said at the start. The first step in the process is to look at risk and say, where is the lowest risk? And so if we look at a number of the commodities in that spectrum, they've been decimated.
Yep.
The supply-demand fundamentals are favorable at this situation. You could make the argument, and I've made the argument to myself because I argue with myself.
Oh, I thought I was the one.
It's a valuable exercise because, look, we're always wrong somewhere, Mark, and you've got to try and find out where you're wrong. So the argument is that global growth will stall, falter, have trouble as a consequence of trade wars and any other sorts of, ramifications of that. And then you say, okay, well, what does that look like? And then you reevaluate and you say, okay, well, what does this particular sector look like? And what are the, so let's go back to uranium because you're an expert in it and you know that space very, very well. So we could make the argument and say, okay, well, global growth's not really good. How's that going to affect the uranium market? Well, for starters, much of that space, these initiatives that are being nuclear plants, etc., that are being built, are hugely capital intensive. When you're a few $100 million in, the likelihood that you're going to turn around and turn the thing off is fairly low.
You're in. Once you're in, you're in.
Exactly. Like you're married now.
Yep.
Like, just deal with it. You know. Yep. You might have been putting on a bit of weight, but too bad, man. So, and then the second thing is that if you look across that spectrum, I think a lot of these things become politically sensitive. In order for China, let's go back to China, in order for China to achieve what China wants to achieve, they need to secure those resources. And they've been doing it across Eurasia and across Africa. So they become politically sensitive. And the most politically sensitive in any of these things is always energy, always.
Yep.
And then if I look at the energy spectrum and if I look at that change over the last 30 odd years, oil's making up less and less of a percentage of that.
Mm-hmm.
And again, that's as a part of that is a consequence of that alt energy boom that we discussed, and the fact that that is actually now economical to the extent that it was never economical before. And so uranium, I mean, we've talked about electric vehicles and things of that nature. And people, that's a big topic that people are talking about now. But the fact is that China is the leader in electric vehicles, bar none, in the world. People have got no idea until you travel and you have a look at what's going on. I mean, they're producing more electric vehicles than any other country in the world. They are building out all the infrastructure for their entire transportation grid in that space. And then you say, okay, well, clearly that's happening. What are the commodities that are impacted? Or what are the commodities that are utilized in the formation of that infrastructure and those motor vehicles and everything else that goes with it? And you come back to things like uranium, where they got like uranium cells, those tiny, what do they call them? Literally mini nukes.
Yeah, small modular reactors.
Yeah.
Yep.
And then you look at, we've been all over cobalt like a fat kid on a cupcake for a while.
Think about vanadium and the impact that just China itself is having. Vanadium is it's a byproduct of some vanadium of some uranium mines, and it also its main use forever has been to strengthen steel, and about 10% of all steel that's used vanadium, and it was trading at a couple of bucks just a couple of years ago, and now it's sitting at about $14, and that's China and battery storage, because it's the next generation of battery storage has something called a vanadium flow battery, and we're seeing there's not enough vanadium in the world, and so as alternative energy expands, you need more battery storage to be more cost effective, and vanadium plays a role in that. And also from a Chinese government standpoint, they've also put in some regulations that require the use of more vanadium in steel processing. So it's impacting that. But there's a commodity a couple of years ago. Even now, if you mention vanadium, most people have never heard of it. But you see its price, go up 5, 6, 7-fold in a couple of years.
And we're seeing, I mean, you and I spoke about this before, and then I've written a couple of articles about it. Like, there's enormous projects in that space taking place. And we're not talking about, a few $1 million. We're talking about hundreds of millions of dollars, billions of dollars.
Yep.
And so, so it's kind of looking at all of these sort of moving pieces and then trying to drill down, because you can look at China and go, is it the currency that you buy? And then you look at, there's all sorts of problems with the currency, and I don't have a strong opinion one way or the other, really. I could easily sit down and give you a narrative as to why I think the renminbi would do well, and I could also easily sit down and give you a narrative as why I think the renminbi could do badly.
Right.
Okay. And so there's no asymmetry there for me. And that doesn't mean there's no asymmetry. It just means that I can't figure that one out. And so you kind of look through different elements of their economic cycle, what they're trying to achieve. And then you find, where, again, electric cars. Do you go and buy an electric car company in China? Well, they're not actually that cheap, right? So no, I mean, it doesn't mean they're not going to go up. I think you could probably make some money on them, fine, right? But so it's kind of going different levels and just trying to find where the greatest asymmetry lies. I think most of that asymmetry actually lies in the commodity space of the assets. And again, and there's two factors here. So like that's just us looking at saying, electric vehicles are going to be something that the Chinese are attacking and going after in a very, very big form. But the sort of more global macro perspective is such that we've got this geopolitical environment that's very risky right now, and these debts that have been built up, again, lack of coordination at policy level, all of these sorts of factors. And then I say, okay, well, if we have problems breaking in that system, and like right now, the market's already giving us indications of that. LIBOR has been on the rise since 2016, and it is just going parabolic, and it's not.
Yep.
It's not changing.
Yep.
And there's something very fundamentally. Look, there's things happening there now. Sure, I think a bunch of that is probably around tax initiatives that Trump's put in, and you've got a repatriation of capital. So there's dollars being sucked out of the system, right? So there's a dollar liquidity problem, okay? Because there's still, most of the world is financed in dollars, and so you take dollars out of the system and financing becomes a problem.
Yep.
And there's a whole list of ramifications that come as a consequence of that, and we've been looking at a lot of them and trading around them. But the point is, in this whole structure, everything that existed post 08 has changed so substantially. And then you say, okay, well, where do you go to in an environment like that on a relative basis for both risk mitigation and profit? And I come down on things, on certain commodities, not all commodities, because they're not all made equal. And then you get even things like Bitcoin. And Bitcoin's super risky on that front. But Bitcoin's interesting in that respect as well, because it actually follows the same cycle that I talked to you about with alt energy.
Mm-hmm.
Right? So the most capital went 2014, 2015, VC capital, blockchain space. That's where it went. Okay. Now, this 2016, 2017 was, call it IPOs. They were called ICOs, but same thing. Fine. Okay. Now, all of that infrastructure that's been built was because there's been hundreds of millions of dollars raised. And some of that's just going to blow away and fine. Probably 90% of those things are garbage anyway. That's cool. People who are silly enough to invest in them, go for it. But the point is that a lot of that infrastructure for that whole, digital economy is being built. And coming out of it, we're going to have a potential for a phenomenal boom again. And it'll be when nobody even thinks it. They will have written off Bitcoin and all these old currencies. They'll be like, oh, this is all gone. It's a waste of time. Right. And it'll literally be like Amazon. You go back and you look at Amazon in 2000. It ran from like $20 to $150, and it collapsed all the way back down. Everyone was like, oh, that's it. You look at a chart of Amazon today, and you can't even see that bump.
Right.
It doesn't even look like it. I mean, we're over 1,000, and it just, it's a tiny little bump. And that was the same cycle. Now, I'm not saying Bitcoin survives that. I don't know. But that space looks very similar, and that's, I believe, where we're going. So, but it also has been much faster in that digital economy than it has been in like resource economies. That whole cycle has been contracted. Now, does it stay contracted, and does it happen quicker? I don't know. But again, when you look at the asymmetry side of it, and when you look at the global economic situation, there's a decent case to be made that where and now exit valves start opening up, as a consequence of lack of policy coordination at central bank level, and where you don't know what else to freaking buy because, Europe looks like they're a mess and the US has got trouble, and like you're just looking at this going, hang on a second, do we even want to own currency? And what currency do we own? It's a very different world to look at. And if I go back and I look at what's happened and my experiences in third world countries, and when you have pretty much the same structure, people want stuff. They want liquidity and they want security of assets. And there's nothing better in terms of security of assets than real stuff. Okay. So there's commodities fit that pretty well. Interestingly, energy, because we did an analysis on this a couple of weeks ago, energy beats out things like the gold bugs will go, oh, you buy gold. Well, not necessarily. Gold does well, but it doesn't do nearly as well as energy. Energy is the biggest driver in that space, because if you
how do you play energy, Chris?
Well, the way that we are playing it, I don't know if this is right. It's been working well so far, so we'll go with it. And I keep arguing with myself, so I might change that opinion. But if we look at oil's look, net longs right now are at fairly extreme levels. So I think we could easily have a pullback in oil. Mm-hmm. However, if I look at the oil sector, and if I look at offshore oil, offshore drilling, for example, that looks very similar to the uranium space. There's nobody left.
Yep.
It's priced as if we will never, ever get oil from offshore sources again. And today, Mike, 30% of oil comes from offshore sources. Mm-hmm. That's a not insignificant amount of bloody oil. And sure, we're going to have alt energy come in and all, but like, we're not going to get rid of oil just yet. So that's a very interesting space.
So you're talking the drillers and the companies that service those drillers.
Yeah. And again, you look at most of them, they've been restructured. You've got companies that all of the debt holders have become equity holders. They've been wiped out. Like, anybody who owns these things is either really, really pissed off, or they're new, and no one's selling. And they're profitable. And they're profitable at what are not particularly great prices. So that's an interesting space.
And left for dead.
Of course, uranium's another one. Solar. We're invested in some stuff in that space. Again, the dynamics of that market are very favorable now.
What are you staying away from? What scares you?
The big energy companies, because for the most part, they got sucked into the passive investment space. So where we've had this movement of capital from active to passive, we've had all of these ETFs and indexes and all that kind of nonsense get set up. And then we've had algos trade them, which, the whole, it's the low vol trade, right? The low volatility trade. And so your utility companies, for example, all typically exhibit lower volatility than Google, Apple, Microsoft, Facebook, whatever, right? And so the argument goes like this. Well, if you've got something that pays off, because most of these are dividend payers, right?
Yep.
If it pays off a dividend and its volatility is half a typical equity, well, isn't it then sort of like a 50% bond?
Yeah.
And
so
it's like
people get run over thinking that.
It's like that's I wouldn't even go into
rates start going up and people rotate out of those. Good luck, right?
Yeah, exactly. So that's where we're staying away from in that space, because the valuations are silly, and they're silly as a consequence of those companies having been included in indexes and ETFs and the like, which get bought automatically by dumb money, by passive algo strategies, which just say, hey, volatility on ExxonMobil is buy it. Oh, it's gone. And then buying, because they've been buying it, it actually decreases the volatility. Right?
Yeah.
And then because the volatility is lower, it says now allocate more to that because on a percentage basis, that volatility is lower than this other company over here. And so it puts more money in. And so you get this wonderfully stupid setup where you got so much capital going into anything that's low vol. And they don't even care if it's utilities or if it's energy or if it's MLPs in the freaking property sector. It just, so we're just staying very, very far away from those. I think over the next decade, they're going to seriously underperform.
You just said something, decade. What's your time horizon when you're looking for out of favor assets?
Well, that's a good one, and it's important because I'm not a trader in a short time frame. I'm more than happy to buy something and sit in it and see it go nowhere for 2 years. Mm-hmm. Again, if you go back and you say, okay, what's my risk? If I've got, let's just take the offshore drillers and transportation companies and shippers and things like that. You've got companies now that have been restructured. They're at the bottom of the cycle. They're profitable. So they've got like no debt.
Yep.
Almost no competition. Mm-hmm. And do they go up in the next 6 months? I really don't care, Mike, and I don't know.
Yep.
I don't know.
What you're trying to figure out is how far down can they go?
Yeah. And I'm looking at them and I'm like these are, you get this weird setup where they're actually deep value plays, like the kind of stuff that, Buffett would be proud to own. Mm-hmm. And so to answer your question, it's 5 years at least.
Okay. So how do you, one of the things we run a risk of being contrarian is a couple of things. One is you fall in love with your thesis. And like you say, you're always arguing with yourself. I do that every day on uranium and any other long investment I have. And same on short side. One of the things, though, as contrarians, you run the risk of falling into value traps. Yep. So I talk about a value trap and what you do to guard against those.
Yeah. So, let's use there's something that we own, which may or may not be a value trap. I think it may be, it possibly is, and there's a lot of ramifications around it. Gazprom. Okay, so Gazprom, you look at all of the metric and you're like, this thing.
By the way, for listeners, that's the Russian oil and gas company.
Yeah. So Gazprom could be a value trap. And a value trap because on the face of it, you look at it and you think this is really cheap and you should buy it for any number of reasons. It's a trap because it's never going to get expensive. And it's never going to get expensive because it's run by oligarchs and because they're going to suck all the capital out of the company and, buy jets and whatever else. Yep. So, that may be the case. Now, again, if you say, well, why would you get into that? Well, if you come back to the first metric, which is what's your risk? Like your risk, if you bought Gazprom for the last 10 years, like you wouldn't have lost a huge amount of money, but then you wouldn't have made any money. Right. You would have just got annoyed. You just sat there and just got, pissed off.
Kind of like sitting in cash for the last 10 years.
Yeah. Yeah. And so I'm not sure how best, look, there's so many different factors that come into it. So like with Gazprom, this is like if you want to buy Russia and you want to buy a capital shift into Russian assets, because right now Russia is probably one of the cheapest markets in the world.
Yep.
And it's probably one of the cheapest markets in the world because people don't understand it. And I'm not pretending that I do, but I do know that most everybody I talk to does not understand it. And they
don't even want to hear about it.
And they don't want to hear about it.
Yep.
And so that's interesting in and of itself. We also know that they are like basically an alliance member with China. Yeah. So they're going to be selling. This trade's going to happen. It's not like this is Venezuela. It's not.
I've seen a number recently where trade is supposed to increase from like 80 billion to 200 billion over the next couple of years.
Yeah. Yeah. Yep. Yeah. But we've probably been looking at the same sort of data. Yep. So then I look at that and I go, okay, if that's going to take place, where are because I'm not going to sit here and try and figure out the small cap companies in Russia. I'm not that guy. Okay. So how do I try and get exposure to that?
You don't want to be that guy, by the way.
No. Oh, look, I've got friends that have worked over there, and look, that's an entire speciality all in of itself. And I've got friends who do dig into that stuff, and they'll often, provide me with information. Go, oh, you should look at this and that, and I've learned over the years to limit my time spent on that stuff because it doesn't give me I can get much better payoffs just looking at the broad themes, finding stuff. Look, what you're doing with uranium, Mike, is it's the perfect example of how this should be done. You've got an entire sector that's been obliterated. You're picking up 20, 30, 40, maybe max companies. You're buying into those in the most favorable terms that you can so that you can often liquidate out a bunch of the capital and hold warrants and things of that nature. And so you're diversifying across the sector that's by most any argument we can say has a very decent probability of going the right way. And if we're even half right, it's going to be multiples, not just, double-digit returns.
Right.
So that's cool. And that's the way to go about doing it. So if I go back to like the Russia argument, say, well, is there asymmetry there? I think there's a very good potential that, yes, there is. Because it's not just like, it's not that something's going to go up or down. It's like things need to just get not that bad in Russia and stuff can double. Like, because everybody right now just thinks it's a complete basket case. It's like no one's ever going to trade with them. It's just, Putin's Satan. And so the narrative is very important to kind of understand and then see how that narrative is priced. Because if the narrative gets even slightly less bad, then that could be quite good for you. So,
Chris, you say something so important that I focus on a lot is the existing narrative. And I think about just like in the U.S. market right now, it's trading at near all-time highs, and you've seen you have 40% of the Russell that's exposed to LIBOR, which is going up. So when they need to refinance, you have that risk. Revenue growth is paltry. Margins have already expanded over the last several years, and the last bit of what you've seen from growth has been a lot of share buybacks driven by borrowing at low rates. And so there's a lot of good stuff priced in. And whether trade wars come to fruition, I don't know. I can make the argument trade wars are not good for stocks. Other people want to say it's not that big a deal. But what I do know is where the narrative is now, so much good has to continue to go on for stocks to keep moving that much higher. And you talk about risk reward and asymmetry. And for me, like when I think about the U.S. market, and I think about the stuff that's creeping into it that just a few months ago wasn't there, that's shifting the narrative. And that changes your risk reward. And you have to constantly look at what that narrative is. And when you're talking about Russia, right, everyone hates Russia. Like you said, everyone says Putin's the devil. What if he's not? What if he is, but things on the margin get a little bit better and you have one of the world's cheapest stock markets?
Yeah, it's like I think about China. So like the Western viewpoint is that we proved after the Cold War that the model is two things, capitalism and democracy.
Yep.
So the Western theology is such that, hey, we proved it. Like, you guys are all fucking stupid. That's how it should be.
Yeah.
Right?
Yeah.
And the Chinese don't care about that.
Yeah.
So they are capitalist, if you want to call it that. But democracy for them is anybody who thinks that democracy is coming to China is just not paying attention at all, because that dog won't hunt. It's not happening.
Nope. Capitalism is.
Capitalism. And I'd like to say, and Jamie mentioned this the other day, mercantilist. They're mercantilist.
Yep.
That's probably a better sort of terminology for them.
Yep.
So, and then things are priced accordingly. Like everybody, like if we took if we took a South America, let's take Venezuela. If Venezuela turned around and said, "Oh, we're going to become a democracy," the market would go up. Doesn't necessarily mean that it's going to get any better. They could,
right.
I mean, India is a democracy, and it's been growing all right, but it's way lagged behind China, and there's very good reasons why that's the case, because it's incredibly there's a whole lot of factors, we won't get into it, but so there's this kind of narrative around what things should look like, and then they get priced according to if they do look like that, and that's where you look for those divergences, where the narrative is either just fundamentally wrong, or it's kind of out of kilter. And so I think Russia could potentially fit into that space where the narrative is just that this is the devil and it's terrible. And look, I don't want to live in Russia, and I don't even necessarily want to invest there, but I'll invest in anything if it's cheap enough and if the risk reward is sufficient for me to make that case. So that's kind of one thing to think about there. The other is that the whole world order is changing, and this has been the case for a number of years now. There's been a couple of commentators who've kind of picked it up, and it's all around this sort of China story. And China's bringing into their sphere of influence much of Asia for sure, and we're seeing that in the South China Seas and
absolutely. In alliance with Russia, I mean, they're fortifying themselves.
Yeah, and then if I look at because I've traveled a bunch, and I'm trying not to the last couple of years, and I lived in Asia for a while with my family. The one thing that really stands out for me is that Asia is just growing. It's got this ballooning middle class. China's literally got them under their thumb because they're the biggest trading partner. Yep. It's just the way it is. And back in the Obama era, there was this sort of pivot to Asia, which didn't ever pivot. I mean, they just literally stayed in the Middle East, as far as I can tell.
Yep, absolutely.
And China likes that because that's just a quagmire. It's like, just keep them in the sand, but let them keep, wasting time and money there while we build our influence in Asia. And that's already now gone. I mean, none of those Asian countries are going to pivot back to the US. That's like, if there's, and again,
you focus on the Middle East, we'll pay attention to Vietnam and the growth that's going on there.
Totally. So there's this entire region there that is on its own can trade with one another in an environment of, shall we say, global trade conflict. And I'm not sure that that's a war that the West can win, because all of the growth in the world is out in that region. That's all under one regime right now. And I'm not sure people have kind of figured that out. And then if I look at pricing, like you just talked about the US markets, you look at the US market and then you look at these markets and you look at how they're priced. And it's like, it's as if it's the other way around.
Right. Yep.
And so there's a lot of asymmetry in that. And so that's, I think, an important space for people to be thinking about.
So, Chris, how do people get a hold of you? Obviously, your fund is closed, as you said earlier, but if somebody wanted to be the beneficiary of all that great brain power.
Yeah, so, I've got a free blog where I occasionally annoy a lot of people. And then I've got the research service, which comes out of the back of that. And so
that's Capitalist Exploits?
Yeah, Capitalist Exploits. You can go to .at, but you can go to .com. They all route to the same area.
Okay.
So Capitalist, as we are, and then Exploits.at.
I'm a huge fan of it. I love reading it. And, I strongly urge people to take a look at the website and your work and subscribe. It's very good. Well, listen, I can't thank you enough for all the time that you spent. We're doing this on a Sunday afternoon, New York time, and it's in the what is it, daytime, or where are you, Chris?
It's morning on Monday morning here.
Yeah, Monday morning for you. And I thank you for getting up early and doing this, and I'm going to have you back.
I'd love to have another chat. It's always good chatting to you, Mike, and I appreciate your time and enjoy bouncing ideas off you, because you've got a great way of looking at things And it's, one thing that I find really valuable with gentlemen like yourself is that you're not sort of restrained by some sort of ideology, and you're prepared to look at things from multiple angles.
Yeah.
And I think that's one of the most important things that any investor can do today is literally just think.
I had the good fortune of being wrong early in my career on a handful of things, and maybe more than a handful of things. And like you said, boy, there's nothing, I've been right more than I've wrong, but when you're wrong, it's a great teacher. So it teaches you to think globally, to be open-minded, and to think outside the box. That's for sure. And like you say, always argue with yourself. Right.
Yep. Absolutely. Yeah.
All right, Chris. Well, thanks. Well, I'll be in touch soon, and we'll have you back on.
Fantastic. Thanks, mate.
Bye.
Okay.
All right. I hope you enjoyed the interview with Chris. He always has some very thoughtful insights. I always enjoy speaking with him. I always come away smarter, and he gives me a lot of nuggets to think about. And so I hope you enjoyed that. Remember, you can follow me on Twitter. I am at Footnotes First. I started using Twitter about a year and a half ago at the suggestion of a few of my buddies. And I have to tell you, I have met some really, really bright people in FinTwit, financial Twitter, as the nickname is. And I never thought I would be a social media user, but I find some really thoughtful ideas, some very good, some people who agree with me, who disagree with me. We get into little spats, but I find it's an interesting form of education for myself, and gives me an opportunity to share my thoughts with people. And you can email me with suggestions. I really appreciate the email I get. So, you're talking to a microphone, and you don't get feedback. So I love the emails. Keep them coming. It's mike@curzioresearch.com. Good and bad. I'm always trying to get better. I'm new at this, at the podcast game. So thank you. Next week, I am going to talk about a subject that we had last week, and we're going to repeat it with someone different, and a topic near and dear to my heart. We're going to talk in depth again on uranium, and someone who is invested in the space and has a viewpoint on it. So I hope you have a good week, and I look forward to next week's podcast. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.